So we're gonna kick off this morning with a bit of more details about decentralized exchanges. We touched briefly on them on the introduction on Monday, but today we'll try to go a little bit further and also investigate some of the drawbacks that are specific to decentralized finance or these automated market maker exchanges. But as regularly do, a generic introduction again for exchanges. Exchanges are really at the heart of the economy, so you can find centralized exchanges all over the world, and these are really like the hotspots of trade. I mentioned on Monday limit order book, so I would like to be a bit more precise here and give you a concrete example of how this looks like for those that are less familiar. This is how a limit order book looks like. So you have bids and asks. So these are the two parties that are trying to come together to reach an agreement on the price of an asset. And you can see here, I think what's quite helpful to see is this spread here in the middle, right? So this is really like where somebody is willing to buy or sell, right? And this is kind of like the difference between these two assets that you can consider. So the further they are apart, the less likely an exchange will happen. And the closer they're together, the more liquid the market is considered in general. What's also helpful to understand is the height. So the higher here kind of this cliff becomes, right? The more liquidity you can exchange at a given price point, right? So if you go, for example, on some of these coin explorers like CoinGecko, CoinMarketCap, sometimes what you can see is the volume that you can trade plus or minus 2%, for instance, from the spot price. Right? And this is typically, this is at least a metric to measure how liquid an asset is. Right? So this would mean, for example, here you could trade like all this quantity up to here if you're willing to go to this price, right? So you can think of it, you can trade all this accumulated quantity. So this is the size of the order times the price, right? So you can really sum this up, and this is kind of the price that you would get if you obviously you need to divide by the specific sizes, but this is roughly the order of magnitude that you can get when you trade in a given direction on a limit order book, right? So it's a very specific way of serving the supply and the demand of the market. And there are other ways. But this is the traditional way of how centralized exchanges work. And what we have seen on-chain are examples of on-chain order books. EtherDelta is probably the most prominent example. So EtherDelta was a decentralized exchange. The coins were in custody of the users. The users were able to deposit the coins in the smart contract of Etherscan. Etherscan was hosting a limit order book, right? So here you had your balance. You can like deposit and withdraw to this non-custodial wallet. And then there's this order book which would serve supply and demand. This worked well. It actually operated fairly nicely. But it didn't reach the orders of magnitude of trade volume that nowadays decentralized exchanges have reached, that we will look at in a bit. So what can we learn from these limit order book decentralized exchanges? Well, they had no KYC AML, which got them into regulatory troubles as well. There were no fees paid to the exchange, at least apparently at the time. And there was no impermanent loss. A property we will discuss by the very end of this lecture, quite a deeper implication of how decentralized exchanges are built nowadays. Some of the disadvantages is we had a fee for deposit and withdrawal, right? So you couldn't trade as quick as, for example, on Uniswap nowadays, where you do not need to deposit, you do not need to withdraw, and the execution was rather slow. So your trade execution depended on your limit order and obviously on the limit on the book, right? How deep the book is, as I just mentioned at the very beginning of the talk. It depended on the market depth, so to speak. The media, yeah.
What do you mean by no KYC?
So to deposit coins here, right? So to deposit and withdraw coins here, you didn't have to pass any KYC checks. You simply deposited your coins into the Ether Delta smart contract.
How is different than other exchanges? Why do you need KYC in the other ones?
So in regular limit order book exchanges, right, like centralized one, at least you do have KYC AML, right? But definitely for decentralized exchange, for other decentralized exchanges that work without a limit order book, you also do not have any KYC, correct? Yeah. Very good. Yeah, one thing though, which makes them actually different from the exchanges that we will look at in a bit, is they are not fully decentralized. So in general, this order book, or at least the mediation of the order book, there was some logic that was outsourced to a centralized server. So if the server went down, then the exchange wasn't able to function. Right? So it's not as robust, so to speak, as a Uniswap or Banco exchange, where you do not have an off-chain component that is required to perform transactions. Yep.
Is there a need for an off-chain component? Is it matching the order book?
I think so. Yeah.
Because you cannot have such a big search.
You can. I mean, you could implement everything in the smart contract. But I guess to reduce gas prices, they try to offload some of the complexity. Yeah. Good question. So our goal, right, for DEX would be to have a trade matching and as well as a trade settlement. But this part here, as we discussed on Monday, this part, contrary to a centralized exchange, this should be realized in a non-custodial manner. Right? So we want this we want the users to keep custody of their funds. And to even further motivate why we need a DEX, right, you can really think of, you have Alice, who's rich, and we have maybe Bob here, who is a nifty trader. And Alice wants to provide her money to traders to earn fees. So Alice doesn't want her supply to lie around and do nothing, right? She would like to perform market making. This is at least the common terminology for limit order books. So she wants her money to be used to serve the market, to serve the supply and the demand. But the problem is she has to trust someone to manage that money, right? So maybe she doesn't want to trust anyone to do this market making on her behalf. And Bob, on the other hand, wants to buy the latest coins that he's interested to try out with. And he struggles to find a trusted source to buy these coins. Right? So these are the two sides of the markets that decentralized exchanges tend to address. And on the very high level, right, we have here, this is comparing the approaches of the centralized markets that we discussed on Monday. So we need to have a price discovery mechanism, we need to have a trade matching, and we need to have a trade clearing system. So these three systems are necessary to perform a swap. And so the goal would be to implement all this within a smart contract. Now, before showing you how this actually works, I want to show you that this is in fact very relevant nowadays, right? So DEX trading volumes have reached substantial amounts. So here you can see the latest numbers up to February this year. So you can observe kind of a decline in the last months, right? So that's because there was an increased interest in 2021 on cryptocurrencies in general, which implies that there were higher trading volumes. And what's interesting here, I found this figure yesterday about the DEX so the decentralized to centralized exchange spot trading volume. So it seems, at least according to this data, that the decentralized exchanges do about between 5 to 15% of the volume of centralized exchanges, which is not that much, but it's starting to be noteworthy, so to speak, right? Just to give you a bit of context of how important are DEXs at all, right, before we go into all these technical details of how they work and where they don't work and where they work well. Yeah, just to position that a little bit. Okay, any questions so far? Very good. So let's dive into so-called automated market maker, right? I mentioned Alice wants to provide her liquidity to the market to earn fees, to earn a return on her supply, but she doesn't want to entrust anyone in particular to do that. So hence the name automated market maker, right? This implies there's some kind of an algorithm that does this market making for you. The idea is really to have a smart contract who does that. And Alice here, she adds liquidity to the smart contract pool. So she has a certain quantity of an asset X and a certain quantity of an asset Y, which she's adding to the pool. Then Bob, the trader, right, who wants to buy the latest coins, he will provide an asset or a quantity of the asset X, and in return, the pool, the smart contract, will return a quantity Y. And the amounts of these two coins, that really depends on the exchange rate and on the size of the swap that Bob here is enacting. And besides the swap, and besides the exchange rate, Bob is also paying a fee towards the smart contract pool. And this fee goes into the smart contract pool itself. And since Alice has access to so-called LP tokens, so for depositing coins, she gets a representation of her assets in the pool. She will then earn a proportional amount of those fees, or she will have access to a proportional amount of fees that the entire pool is accumulating while Bob and other traders trade with the pool. So these LP tokens, that's a very important concept, right? So this is it represents really a share of the pool, and they do the accounting. They can be fungible or they can be non-fungible. You can also sell them on the secondary market. You can put them into another pool that people can then stake with. So you can do this like on multiple hops even. So it's really the money Lego, right, that we refer to on Monday. So now you may ask, well, okay, that's beautiful and good, but how does it actually work, right? I mean, what are more of the details? So the way the simplest automated market maker works is through a constant product market maker formula. So you have X, which is the asset quantity of the asset X, times Y, which is the asset quantity of the asset Y. So these quantities, they should be equivalent to a constant K while you trade with the pool. So it's important to point out that's only valid, the K should only be constant while you perform swaps with the pool. So the idea is, if you have such a formula, you get instant liquidity irrespective of the trade size. I mean, that sounds like magic, right? If you look at the limit order book, you know you have this, you might have a cliff and then you have just limited liquidity on both sides. And here, these automated market makers, they suddenly promise instant liquidity. That sounds too good to be true. We'll dive a bit into why that works in the next slide. But before, I just want to just outline the generic properties. So it's really similar to any market. So if you purchase an asset X, it will increase the price of X and vice versa. Right? So demand will increase the asset value and vice versa. What's interesting is here the ratio of these assets sets the price. So the smart contract can act as a price oracle. Right? The smart contract knows what are these assets worth in relation to each other. Right? What's the relative price of these assets? And in general, this is known as a constant product ALM. There are other variations with more than two assets and with different functions, which we won't go in today. But this is really the base. If you have understood how this works, you've understood, like I would say, 70% of DeFi. Right? It's really that simple. Yeah, question?
Was this mechanism used before the decentralized exchanges?
So the question is whether this was used before decentralized exchanges. I believe there were some works that proposed this before. I'm not fully sure though on when and whether it was exactly this. I saw some, but I haven't followed up. So I saw something that it was used before in centralized finance, but I must say I haven't looked up to what degree and to what magnitude it was used, and whether it was precisely this and with the same properties. Yeah.
Yes, from the early 90s.
Oh, are they? Okay, I didn't know. Right, yeah.
What is the mechanism if Alice, the liquidity provider, wants to remove liquidity from the pool?
Right. So, okay, let's go quickly back here. So here, this is we've shown the add liquidity mechanism. If you want to return, if Alice wants to return, ask the pool to return X and Y, right? The base assets that she put into the pool, she would need to do what? She would need to return the LP tokens, right? So let's say you have a certain amount of LP tokens, and let's say they represent 10% of your share in the pool, right? So it will just mean the smart contract will take your LP tokens, will burn these tokens because nobody needs them, and will return to you the proportion of the assets that you're entitled to.
And she'll get back the exact same amount of X and Y she put in?
That depends. So, if we assume that Alice does an add liquidity operation, nothing else is done on the exchange, no swaps, nothing, and then she withdraws, she will get back exactly the same. Right? If in the meantime people swap assets with the pool, or for example, do arbitrage because the price changes on external markets, then this distribution will change. Yeah.
But isn't that like not market making in some sense, because she's like taking on position?
I mean, market making is similar, right? You provide a certain amount of assets, and they're being used to trade, right? You're serving the market, right? So you will most likely, if you do market making, even on a limit order book, I mean, you will end up with a different distribution of assets, right? Typically. Yeah. Question?
How does the contract make a profit?
So that's a good question. So the contract itself. So the question is, how does the contract make a profit? The contract itself is, I guess, not interested to make a profit, but it's the LP token holders that would like to make a profit, right? So here Bob is doing the swap, and he's paying a fee to the smart contract, and that means besides just the swap, he's adding liquidity to the pool, right? So the supply of the pool, at least in absolute value terms, should increase. These fees are rather small. It's like, I think it's on the order of 0.4% or 0.04% roughly, depending on the AMM. But the fee really implies that if you're just providing liquidity, the total supply of the pool should increase, right? At least in theory. Yeah. There was another question, or yep. So does it matter how you pick up K? That's an initial parameter. So so typically, it does. It is. If you think of the market as a general structure, you will pick a fixed ratio, because you will take the same ratio as the market tells you, right? So the ratio defines the price of the assets. So if the price is whatever, 1 Ether is worth $100, then you will take that ratio of ETH DAI that you put into the pool, right? And that will determine K, right? And then depends, what's the quantity that you supply to the market, yeah. So I guess typically that's kind of set by external prices, yeah. Yeah, question?
I think for Uniswap, when you create a new coin, you want to add liquidity, have to add the corresponding amount of users, right?
So Uniswap.
Not create a new coin.
Yeah.
You want to trade it on Uniswap. Have to add one-on-one correspondence into the smart contract, right?
So the question is whether on Uniswap you need to add like a corresponding amount of Ether to the pool of the assets that you want to trade, right? For fresh, so a new coin that's not yet, where there's no market yet, right? So there are different versions of Uniswap that exist. I believe the first version only traded against ETH. So any token that you added, you needed to trade against ETH. So in that case, you need to add the corresponding amount of ETH. but at the ratio that sets the price, right? You don't want to set some other ratio because otherwise arbitrageurs will just even it out immediately afterwards for you. I think Uniswap version 2 then implemented the ability to have pools that are non-ETH based, right? So you can have two assets in a pool that are more freely, right? It's less of a star topology as such from an asset perspective. And then there's also Uniswap version 3. We won't go today into Uniswap version 3. Dan Robinson actually has a very good lecture just on V3, I think, by itself, which can be a whole new lecture. But on a very high level, what's interesting about V3, it approaches a bit the limit order book concept. So as a liquidity provider, you can specify a range of prices where you want to provide market making, right? So, and this is a little bit of a hybrid between a limit order book and just a constant product formula as we see here. Yeah. Another question? Good.
X and Y both grow with fees in particular. How can they
That's true. I mean, due to the fees, K is growing slightly, right? But the swap, for doing just the swap, right? K has to be constant. Because of the addition of the fees, the supply of the pool is then growing, so K will also change slightly. So very good. You paid good attention. I was actually about to ask, what are the circumstances under which K would change, right? So you implicitly answered the question by implying that if you add fees to the pool, well, K would change a little bit, right? Are there any other circumstances where K would change more?
Like liquidity is added by liquidity.
Exactly, right? So if you add liquidity or if you remove liquidity, then K is changing too. So that's why this notion of constancy, I mean, it's not too constant, right? It's definitely K is changing over time while people and entities interact with the pool. Very good. I mean, I have so nice animations now to explain to you the AMM, but I feel like you've already got it. Okay, so let's dive into some concrete example, right? The curve here that you see, this is called a bonding curve. On the x-axis, you have the amount x of asset x in the pool. On the y-axis, you have the amount y of the assets in the pool. And we describe the state as the state of the AMM, right? So here in this example, you have x 10, y 30. So k in that example is 300, right? For the sake of this example, we will ignore fees. And this makes it easier because k will be constant if we ignore fees, right? So let's say we would like to purchase 10 coins of the asset y. How many coins of the asset x do we have to provide to the pool? So we are here at 30 at the moment, right? We want to purchase 10 coins of the asset y. So that would go to 20 because we take out 10 from the pool. But to do that swap, right, for the smart contract to be happy to do that swap, how many assets, what amount, what quantity of the asset X do we need to provide to the pool? Sorry?
15.
The difference, exactly, 5, right? So we need to add 5 coins here. So we need to go from 10 to 15, you're right. And then the smart contract would say, okay, fine, I'm happy. I'll give you the 10 Y coins, right? That's really the essence of how an AMM works. So you can see we're moving here, the price of the exchange is moving along this bonding curve, right? Which also implies that, or which kind of clarifies why we have this property that we can have instant liquidity. It's because the price definitely changes depending on the size of your order, right? So the bigger your order becomes, the worse the price gets. And that's typically referred as slippage, right? And that's, we call this the expected slippage because you can calculate that slippage offline, right? So if you know the blockchain state, you know the asset quantities X and Y, you know the constant product formula, you can calculate how much am I gonna get, right? What's the expected a decrease in price against the spot price that I can see on CoinMarketCap or these exchange websites, right? So you can really see what's the price impact of your trade. So the price impact is typically how much worse is my final or average price going to be. Is it like 1% worse? Is it 5% worse? And here, if you use decentralized exchanges, please be wary. You should inspect, right? What is your price impact? If you're trading a significant amount on very illiquid markets, you may lose up to 90% of your coins, right? It's nowadays the DEX websites are getting better, but still you can make a faux pas on the exchange websites there. All right, so this is the slippage. And obviously we can have an unexpected slippage as well. So how would that happen? Does anybody have an idea? How can we have unexpected slippage? Yeah?
Someone made trades in between.
Exactly. Like when we refresh the web UI of a decentralized exchange, the web UI is fetching a blockchain state, right? Uniswap, for instance, shows you the block number actually. So that's the representation of a given state. Now, if somebody else performs a trade before you, here in this example TD, right? They may trade before you in the same direction, right? So you may end up with a worse price. Can the other direction also happen? Could it happen that you end up with a better price than it can also happen, right? Yeah. It's both sides are possible, right? You can really have unexpected slippage that's positive or negative. All right, so just let's summarize a bit the pros and cons of an AMM. So the good thing is there's no order book, right? We just have this constant product formula. We don't need to maintain the order book per se, but the AMM needs to have or needs to be exposed to arbitrage, otherwise the price will not change, right? So we need to have arbitrageurs that maintain the price on an AMM, otherwise the price may be outdated, because the exchange obviously doesn't exist in isolation in the world, right? We have other markets where the same asset pairs are being traded. It's rather simple to implement a constant product AMM. Bancor, to my understanding, was the first, and Hayden really implemented a very simple version, and I feel this simplicity of Uniswap really led to its success. And this was the genius move, really, of Hayden, right? To have a very simple and user-friendly product, right? So if you venture out to build a DeFi application, a novel DeFi application, if you aim for simplicity, it will probably get you quite far, right? Just keep that in mind. Lessons learned from others. There is a danger of impermanent loss that we will discuss a bit later at the very end of this lecture, and there is definitely high slippage for low liquidity markets, which we already discussed. And there are also so-called sandwich attacks, which we briefly touched on Monday. We'll go a bit more details today. But before discussing these, I would like to just, again, for completeness, right, discuss how transactions propagate in the network. I think some of you have already mentioned that there may be some people who trade before you. I just would like to visually explain what that means in concrete terms, right? So if you perform here a transaction, right, and you're somewhere in the world, and you submit this transaction somewhere to the blockchain network, then you're paying a certain fee, right? And this transaction then propagates among nodes in the network, and this can be forwarding nodes, it can be miners, validators nowadays, it can be relayers or block builders. So there are really a bunch of entities in the network that will forward your transaction. Eventually, it will reach a miner or validator, and the elected leader of your consensus mechanism will then choose to import or to order this kind of transaction. In Ethereum nowadays, it's the block builder who does the ordering, but it's the same concept, right? So some entity, will have the authority to order your transactions. So the mempool, this is the list of pending transactions that are not yet pending to the blockchain, is often sorted according to gas price or according to the value that you're willing to pay for inclusion. So the higher your value, that you pay, the earlier you get included, which is typically of benefit because you know on which state your transaction will execute. Right? So in this example, I'm just showing a very simple block with 3 transactions and these ordered transactions. But we always have to understand, right, that we have an asynchronous blockchain peer-to-peer network. So the propagation is the best effort mechanism there. We do have some transparency, so you can spin up your own nodes and see what other nodes propagate towards you. But there may be other peers that try to front run your transactions. It's not really high frequency trading in the traditional sense, right? Because as I mentioned on Monday, these are on the order of milliseconds or hundreds of milliseconds, whereas traditional high frequency trading are definitely on the shorter time scale. But what's interesting is we have these, especially on Ethereum, we have now different types of fee auction mechanisms. So we have the price gas auction, which is occurring on the public peer-to-peer layer. So you can see what other peoples are bidding for their transactions, and you can counter bid, or you can even blind race. So you can make one bid and then make another bid even before you see a response from other parties, right? So you can really learn an agent and apply different strategies here. But there's also a different auction occurring in a more private way. There's a sealed bid gas auction that's happening on these relayers, like Flashbots or BlockXroute, where you have a centralized network relay service where you can do this bidding, right? And Dan will speak a bit more today also about the next steps here. So this is really important because this will help you to understand why it's even possible for sandwich attacks to happen, right? Which I would like to dive in next. So before we go into the concept of a sandwich attack, a swap on an automated market maker is a market order. A market order means I want to execute now whatever the market is providing me in terms of liquidity, right? So you do know what's your price impact, and I just want to get this amount of liquidity sold, right? That would be very dangerous if it wouldn't have any kind of protection, right? And that's why what we have typically in an AMM, it's a slippage limit or a slippage protection, where you can specify, for instance, so this is actually a UI component here on Uniswap. You can specify, for instance, I'm willing to deviate by 1%, right? That's from the market price, right? So what happens if you put this too tightly? What do you think will happen if you put it like to 0.001%? Yeah.
The trade doesn't go through.
And why?
Because the slippage.
Right, but because of the unexpected slippage, right? So that if it's too tight, then any swap in the same direction of you will give you a bad enough price so that your slippage limit will trigger, right? Your slippage protection will trigger. Yeah.
It's not just a limit order in the normal exchange.
Exactly. It's very similar to a limit order, but you have like more of a range, right? In a limit order book, you typically say I want this price, right? There's no wiggle room, right? Here you have a window, like a percentage. Yeah. Yeah.
Is the slippage tolerance added up to the expected slippage?
Yes, that's my understanding.
I thought it would work the other way around.
So
if you set the slippage tolerance too low, even the slippage just caused by your own trade might cause failure.
So the expected slippage is the price that you're expecting to get given the current state, right? And to my understanding, but I guess it also depends a bit on the implementation, right? The slippage protection would say I'm happy to deviate from that price by this percentage. Yeah, but you can really implement it however you want, right? Because if you do not follow, so if your slippage protection will not be based on the expected slippage, then some slippage protection settings will not make sense, right? Because if your trade is quite large, then the forward expected slippage may exceed 1%. So then you would need to adjust this parameter every time, right? And adjusting this parameter is really hard, by the way. Yeah, that's why there's this auto function. Yeah.
Is it an upper limit and a lower limit, or is it just a lower limit? So does it also, stop you if you would profit too much?
That's a very good point. So I think, I haven't checked the implementation, I think it would not stop you if somebody trades in the other direction before you, because it's just to your benefit, right? So why would you fail? But there are some cases, for example, aggregators like 1inch, their business model is that they give you an expected price. If the market moves in the other direction and you could get a better price, they take the benefit.
Yeah, that's what I expect.
Right? So in expectation, I guess in 50% of the cases they make money, and but you have a slippage protection. Very good question. Yeah. Okay. Yeah, speaking of the auto parameter, I have not looked how this, like into the details of how this works. So that may be an interesting paper to write, right? Like how do you auto set a slippage parameter? And does it actually help? Or maybe is it worse? I don't know. Like that may be an interesting research project. So yeah, the idea of a slippage protection is really if you cross it, your transaction will fail, right? The swap will not occur. That means you're still liable to pay transaction fees, right, to the miners for a failed transaction. Okay. So the idea of a sandwich is really to push you to this edge, right? You want to, the adversary will push you to the slippage protection, but not over it, right? So there will be the A1 transaction that reduces the price that you get, and then A2 will trade in the other direction just to profit off from this difference. So that's why it's a sandwich, right? And that's why it's also important for you to set the slippage parameter to be tight enough for the trade to pass through, but not too tight so that it would fail as was suggested, right? So you can, depending on your transaction that you're performing, you can play with these parameters, and be sure if you do set it too wide, you will get sandwiched. There's almost a guarantee nowadays, at least on Ethereum. Yeah. Question?
Can Arbitrage see when transactions are submitted to the man what you set as slippage, like your tolerance?
Yes, that's transparent. Yeah, you can see it. Yeah.
Because if you could hide that, maybe it would be harder to do.
If you submit a transaction to the peer-to-peer layer, the transaction content are visible, and this includes everything, right? Your balance, how much you want to swap, your slippage protection, etc. Everything is transparent. Yeah. Question?
Can you do this attack without running your own node? Is it even possible, especially after the merge? Or not really? Because like in your example, you had transaction fees 1051, so like the rational validator would order them that way, but he could also just look at that sandwich attack and steal it from the attacker, that type of stuff.
Right, so the question is, do you need, like, what's the infrastructure that you need to execute this, right? This is kind of your question. It's a very good question, because I was just about to show. Thank you. We don't have to go into all details. It's rather simple. It looks maybe even a bit more complicated than it should be. But let's say we have here the victim, right? This is the trader. The trader submits a transaction to some RPC endpoint, right? For example, in MetaMask, if you submit your trade to the RPC endpoint, then it should be broadcasted on the peer-to-peer layer, right? So this is how it gets sent out. Then it's somewhere propagating in the Ethereum network. And I may add, this is one way of submitting a transaction, right? You can also go through these so-called private relayers to try to avoid the mempool. That's also possible, right? But in general, a victim goes through here the peer-to-peer layer. Then the miner has a node and the attacker has a node. What I call here a spy node for the adversary is a node that has more TCP connections than an average Ethereum node. An average Ethereum node has, I think, about 50 TCP connections in the network. If you run a spy node, you may have between, 500 to 1,000 TCP connections with the intent to receive transaction as early as possible, right? Every second really, or millisecond really matters here, so that the adversary has time to construct the sandwich and to also send out the sandwich. So you have these nodes. Here in particular, the transaction gets added to the mempool, and the adversary starts to observe the swap. So once the adversary observes the swap, the adversary would need to compute, is this a profitable, can I construct a profitable sandwich, right? That's not always the case. As I mentioned on Monday, I estimate around 6% of the existing swaps are sandwichable, right? Not all of them are profitably sandwichable. So if it is sandwichable, then we will construct this TA1 and TA2, right? So the front running and the back running. And we send it to the SPI node. Eventually, the SPI node will broadcast it. Because it has a lot of TCP connections in the network, it is well connected. This broadcast process is rather quick. And then hopefully at some point a miner or validator will pick this up and include that in the blockchain. So what are the risks here for an adversary? Yeah.
The ordering of the transactions and that they'll be included in the same block.
Exactly. So there are a bunch of risks, right? The first one is you must successfully front run and you must successfully back run, which is a big if, right? Front running is a little bit easier to control because you can tweak the gas price. But for back running, you typically issue the transaction at the same gas price, and because it propagates later, it is assumed that the transaction will be executed afterwards. But if the adversary is too well connected, then his back running transaction may propagate too quick and may front run instead of back run. Right? So it's actually quite risky to perform a sandwich in an open network. Yeah. Any other risks you see? Yeah.
There's probably also a risk of like double sandwich where both adversaries are trying.
Yep. We'll go into that. Also look into the profitability of double sandwich or like multiple adversaries afterwards. This is a very good point. So in general, yeah, another question.
Well, why doesn't the miner just do it?
I wonder myself every day. So the miner could do it, and the miner would have no risks.
That's what happens in like the normal financial system, usually. I mean, the bank will do it if they can.
So traditionally, miners were really strong. The core business of a miner in proof of work was to source great hardware, cheap electricity. This is their core business, right? They were not concerned, or not very concerned about the network layer or even the application layer, right? So I think that's one of the explanations why, at least historically speaking, especially in Bitcoin, miners were really focusing mostly on the mining business. Nowadays, since we have also the transition to proof of stake, I think it will eventually go there. Yeah. Yep.
There's also a risk not just of another adversary that does a sandwich attack as well, but also any other trade that may occur. Because then, if I really try to push the trade of the victim really close to the slippage protection, if there's any other trade before that happening, which I'm not aware of, for example, then I just push him over the slippage protection.
Absolutely, right. So there are a lot of risks, right? I think we all agree. I would like to point out just one thing, because there's often a misconception that things have to happen in the same block. That's not really the case. The conditions that you require for a successful sandwich is that the order is preserved and that there's no intermediate swaps that somewhat mess up your sandwich. But technically, you can have a sandwich across 10 blocks, because all that matters is just the sequence of transactions that you're looking at against that particular AMM market, right? And we have seen that sandwich attacks are sometimes hundreds of transactions away from each other. They're not mined like precisely, beautifully, like next to each other in a block. If you look at Etherscan, for instance, right? So you can have so-called, you can have sandwiches that are executed across blocks, right? That's definitely possible. At the end of the day, it's about the state transition against this given smart contract pool. Okay, cool. So another like schema to visualize how this would work is you have a blockchain state N, and later you have a blockchain state K, and there is some time appearance on the blockchain network, and you have this transaction here, this pending transaction that gets sandwiched within these adversary transactions. Now, to mitigate the risk of a sandwich attacker, nowadays you can use these relay services like Flashbots or BlockXroute, and because in these relayers you submit a bundle, which is a collection of transactions, you can precisely control atomically, actually, the execution order. That's not, so you cannot by default create a bundle on the open peer-to-peer network, right? You cannot collect another transaction and bundle it within your transaction. But with the relayer system, you can create such bundles, right? This makes a sandwich attack much less risky. Actually, there's no risk, because even if your bundle fails, you will not be liable to transaction fees. Right? So that's how nowadays sandwich attackers are executing these swaps. Okay, so we have just like 3 more slides on sandwich. I think it's good to dig a little bit into the details of why and when a sandwich is profitable. So this figure looks maybe a bit more intimidating than it should be. I'll really go through each axis here. So on the x-axis, you have, for example, the ETH transacted by a victim, right? So we're targeting a particular Uniswap pool here. And on the y-axis here, you can see the ETH transacted by the adversary, right? To perform the sandwich. So you can see here, the bigger the transaction volume of the victim, right, the more likely we end up in a green area. And this is the area where you can make a profit as a sandwich attacker. So the parameters that you can kind of like think of is, so how much is the victim transacting? So let's say the victim is transacting 40 Ether, right? Then the adversary probably only needs about like 12.5 or 25 Ether, right, to be in this green zone, where the revenue of the adversary, of the sandwich adversary, is positive. Okay? You can always look at different slippage settings as well for the victim. And so we have here these 3 lines for the unexpected slippage that the victim is willing to take. This actually answers also your question implicitly on whether this is the unexpected slippage. And here what you can see is the lower you set the slippage, right, the less likely a swap will be profitable. Right? So the less room there is for a sandwich attacker to attack. And to be honest, I would love for exchanges to implement like a warning, right? Your transaction will yield X $US as to a sandwich attacker, to an optimal sandwich attacker. Because this is what nowadays we can do, right? We can, on the UI of an exchange, we can measure how much sandwich volume can we extract from your trade that you just submitted. Are you sure you want to submit this trade? Or maybe you want to modify your slippage setting, right? I think it would be great to improve on the UI side just to protect users a little bit further. Okay. And finally, for your questions regarding multiple adversaries. So we've tried to simulate just a local experiment, really. What's the break-even for attackers if there are multiple sandwich attackers? We did a small simulation, so that's no ground truth, right? But that's what we expect that could happen. So the more adversaries you have, the harder it becomes for an adversary to break even, right? Because you need to pay a higher gas price for the front running. I guess in Ethereum now, so this is assuming the sandwiches are happening on the peer-to-peer layer. I feel like nowadays most of the sandwiches are going through relayers, so it would probably look similar, but it's not about the gas price any longer. It's more about the bribe ratio that we're willing to pay to the miners. And last but not least, I've shown you a very simple sandwich case, right? There are other sandwich attacks that you could think about doing. So feel free to be also creative. Maybe you can come up with new style of sandwiches. You could have we just looked at this case, right, where a taker can attack a taker, but maybe a liquidity provider can attack a taker, right? Maybe you can do I think that's a withdrawal, and then you redeposit. So there may be other ways in which a sandwich attack could be done by entities. So you can really get creative. I mean, we haven't quantified any profitability results on like more advanced sandwiches, but feel free to really try different strategies and explore the space. Yeah.
Just on an intuitive basis, on the right side, wouldn't it be more profitable for the attacker to switch A2 and A3? Because otherwise he's trading at his own, he's causing his own impermanent loss.
So you would first trade against and then...
Trade against before re-providing the liquidity.
Exactly, because you would have a higher price impact if you trade against if there's less liquidity in there. Right. Yeah. Could be. Yeah. But again, these things can be quantified, right? I mean, you can draw actually similar plots to this one. And that would really tell you very quantitatively, right? What's the optimal strategy, given the state. Yeah. Okay. And yeah, maybe some of you want to create some double burgers or something, right? Instead of a simple sandwich. So yeah. Again, feel free to get creative here, right? All right, I've got only 10 minutes left, so I need to hurry up a little bit. I think we already discussed arbitrage quite a bit on Monday, right? Just to recap. So arbitrage is here, you have different markets, right, with the same asset pair. There can be much more complicated arbitrage, I'm simplifying here. But the idea is really that you exchange, you try to even the prices across these three markets that all have the same assets, right? So we have multiple markets with the same asset X and Y and different prices, so they need to be synchronized. And the difference among the markets is typically referred to as the spread. And because we have atomic composability, right? We can perform this arbitrage within one transaction. So if we have access to 2 million USDC, then we can perform this swap and followed by the other swap, right? What if we don't? If we are not a millionaire, what do? Flash loan, exactly, right? So then we have flash loans, and we've seen this on Monday. Okay, I won't go into further details here. Now, how do you detect arbitrage? Like, what are the mechanisms for you to identify opportunities? At the end of the day, it's a search problem, right? It's a search problem given a graph of markets. One traditional algorithm that's being used in traditional finance is the Bellman-Ford algorithm. It's a negative cycle detection mechanism. And it's being used in DeFi. So we've written a paper that explains a very simple Bellman-Ford approach, which seems to work at least in DeFi. We've also tried to apply a theorem solver where we encode DeFi protocols, and this as well enables us to be a bit more generic. I mean, it also enables us to find arbitrage. So the different approaches really you can try out. The faster your algorithms, the better, right? You can think of implementing Bellman-Ford on a CPU. Maybe you can implement it even on GPU and parallelize the search. You can get creative. Maybe there's a way to apply reinforcement learning. I think it's a really interesting problem to dive into if you want to if you want to build an efficient search mechanism. Yeah.
Why do we get efficient algorithm? What is the graph size?
Right, so what's the graph size? So you have on Ethereum, and please don't quote me on these numbers, but you have tens of thousands of exchange markets, right? And you have, I think, hundreds of thousands of, for example, ERC20 tokens. So you can't put everything into one big table and build and find a negative cycle, right? So you would need to constrain your search to some subtree of that market size. But the faster you are, the earlier you can broadcast or submit a transaction, right, which would take advantage of this arbitrage opportunity. So it's kind of like a race.
But the fact that the transaction themselves will take time doesn't avoid such attacks. You can find an arbitrage, but then you have no guarantee about the time to take the transaction.
So the fact that you mean the transaction latency from transaction, right, from transaction creation until it's included in the blockchain. So there's definitely a latency of, again, in Ethereum, 12 seconds, which is now rather constant, which is a very cool property. It does. So I think it's not that relevant because.
You implemented such arbitrage?
Yeah. Of course. Yeah. I mean, for the paper we have to, right? We need to know whether what we write is practical, right? Otherwise, yeah. But typically, and this is not always the case, but typically the way transactions are propagated is that the first one gets prioritized, and unless there's another one competing with a higher transaction fee. And so you could have a better algorithm that's a little bit slower, and because it's better, you are able to pay a higher transaction fee, and you would still break even, for example, or make a profit. But you will have this constraint of the 12 seconds, right? So it's always better to be faster in these kinds of games.
No, what I'm asking, you're not stuck in the middle when you start to do you want to exploit some cycle, negative cycle, and then you get, because it takes time, so it's very risky, right? And you try to exploit the cycle, and then it's stuck in the middle because something changed, because of the time delay. It's not an issue.
I think I'm not fully understanding the question. So what do you mean?
Even if you find some negative cycle, you can exploit it.
Right.
I guess. That's intention-wise. How do you do that? You do it in parallel for all the paths, all the edges, or you start going because of the latency.
So maybe you mean, because Bellman-Ford will return one negative cycle, it will not return all of them, right?
You need to follow the cycle, that might be long, right?
Yes, and because the cycle may be long, so most arbitrage are like 2 or 3 hop arbitrage, right? So we've seen some bigger ones, maybe 6 hop arbitrage, right? But most of them are rather small. That's a good point.
Maybe like 100 of them.
You could do that, but it will take a long time, right? Yeah.
It seems much easier to watch for transactions and detect if someone's doing such a cycle. Could the miner just watch for arbitrage cycles and then do it themselves instead?
Right. So the question is whether you can just copy-paste kind of what others have found. That will be part of my favorite lecture this afternoon. Yeah. So I think this is one of the easier approaches, so to speak. Yeah. Very good. All right, so the last thing, so I have 5 minutes left. We just briefly discuss impermanent loss. It's a very important concept if you are a liquidity provider in AMMs to understand what are the possible risks that you're exposed to. Because let's say we have here an example. Alice is a liquidity provider. She adds to the pool 1 ETH and 100 DAI. Which is at that point in time worth $200, and which would represent 10% of the pool, right? So let's assume this is the state after Alice added the liquidity, right? So she owns 10% of this pool. So this also means she has LP tokens that represents a 10% share of that pool, right? So the exchange rate here is 1 Ether is 100 DAI, and let's assume for simplicity that 1 DAI is $1, right? Hence, we have $200 in the pool. Now, what happens? Crypto is volatile, right? So the price of Ether increases. Let's say it increases by a 4-fold. It goes from 100 DAI to 400 DAI. So what happens next? Arbitrage. exactly, right? We mentioned that the AMM is not like modifying the price by itself, so it needs external forces to equilibrate the price. So there will be some arbitrage trader coming, and here mind the transition. So before we had 10 ether, 1,000 DAI. The arbitrage will switch that ratio, and the ratio, remember the ratio in an AMM defines the price, right, of the assets. So now we have 5 ether and 2,000 DAI. So that means if Alice were to withdraw at that point in time her liquidity by providing her LP tokens to the pool, right, and getting 10% back, so 10% of the pool is 0.5 ether and 200 DAI, right, which is equivalent to $400 US, right? Would she have made more money by just holding onto her coins? She would, right? Because, so just holding onto her coins, 1 ether, right, the initial 1 ether and the initial 100 DAI would now be worth $500 US. So she kind of lost $100. Right? I don't like the word lost because she made money, but she could have earned more. Right? Maya?
So you're assuming that the US dollar to ETH and DAI doesn't get updated during the break, because you don't, the to US dollar exchange rate is updated regardless of the current state of the blockchain. It's not that. So, like, when are these exchange rates to the US dollar calculated?
Right, so the price increase, this one here, right, is happening outside of this AMM, right? So I assume the existence of centralized exchanges or other exchanges where the price fluctuates. And that's why we then have an arbitrageur who will try to synchronize the price.
No, but how do you calculate the exchange rate with US dollar? Because you initially assumed that this is worth $200, and now you're saying that it's worth $400. How is this?
So the ether value is assumed to be equivalent to 100 DAI here, and we assume 100 DAI, or 1 DAI is equivalent to $1, right? And afterwards, we still assume the same, that 1 DAI is worth $1, right? So we have 200 DAI here, and we know that the exchange rate from ETH to DAI is now 1 to 400.
I'm asking why wouldn't the US to DAI exchange rate be updated when the ETH to DAI exchange rate is updated?
I mean, we assume the DAI is not changing here in that example, right? Or, which is not necessarily realistic. Stable coins are not always stable. Yeah. A question? Yeah.
Yeah, I don't fully understand why permanent loss is frequently used as a flaw in the entity. We're talking about like passive liquidity providers.
Yeah.
The liquidity providers are active and they see that the price goes down, they can adjust their position. So why do you think arbitrage is still considered as a flaw?
Right. I mean, I don't want to judge too much whether it's a flaw or a property, or I feel it's a consequence of the design of an AMM, and you can, if you don't want to be passive as a liquidity provider, you can always remove your funds or you can add more, right? Like at the end of the day, you leave your assets to be traded according to this constant product formula, and you abide by that rule, right? And that's just the decision that you do as a...
As a liquidity provider, I could distribute my orders in a way so that I get the same liquidity purchase strategy as I would if I joined the event.
Right.
And that would also be permanent.
Right.
So
you could model, exactly, right? You could model the distribution similar to a limit order book, right? You could provide your liquidity similarly. I guess it really depends on your strategy then, as a liquidity provider, on how you allocate the assets. Yeah. Yeah. Another question?
If there's a market maker in some centralized market, to be market making, wouldn't this permanent loss wouldn't he just call it a loss?
The term impermanent loss is highly disputed, I have to add. Yeah.
Wouldn't, if there's some, like, I don't know, some guy who hasn't heard of a blockchain, just been market making on some centralized market, wouldn't he think about it as in, okay, I took some risk, market making, and this is a loss, right? That's how he would think about it?
I feel, I mean, in this case, I actually wouldn't call it a loss because Alice realized the profit at the end of the day, right? She went from $200 to $500. Yeah.
There's another model for dealers called the trainer model. And the trainer model is much more local, so you actually exchange, you create the price according to your risk, not according to the external market.
Risk meaning?
More appropriate, because then you would never actually do this trade with the arbitrage guy.
So
essentially, like when you go when you're not balanced, when you go too much to one side, you increase the price.
Right.
You always want to be balanced.
I guess that's then the so it's you say that's called the trainer model. Okay, I guess that's probably the intuition behind Uniswap version 3, right? Where you say I'm a liquidity provider, but I'm willing to provide in this price band and not beyond, right? So that such extreme swings will affect you less.
And you actually sell for like more if someone wants to get you out of balance to make it worth their while.
Right. We can learn a lot from centralized finance, right? We don't need to reinvent the wheel exactly. So thank you for pointing to those here. Yeah. Okay, good. I think I'm out of time. Yeah. This impermanent property is not really realized until you withdraw your funds, I have to say, right? The prices can go back in the other direction. That's why the term impermanent comes from. It can result into a total loss if you're being pushed too far in a direction. But it's probably just a generic property even of limit order books, as was mentioned, right? So that's not really unique to AMMs. It's just probably unique. It's probably just a property of this. I'm willing to let my liquidity be traded in any direction at the end of the day. So you can visualize the impermanent loss also depending on the relative price change of two assets, which will help you quantify the value. And there are websites that allow you to quantify it as well. Yeah. Question?
Right. So you kind of goes a bit too good when you just consider an example where price is right. We imagine that the price fluctuates but stays the same like in the long term. Then if we think about the arbitrage, by definition expires some value. So I just wonder if there's any nice ways to visualize what happens over the long term without like considering various situations.
So there are, I've seen some websites that quantify the impermanent loss over time for a given position, if that's what you're asking. So you can, because of this transparency, right? You know what the prices are, you know what the amounts are, you know what how the price moves. You can visualize this or quantify the impermanent loss or price changes in general very, very nicely. Sorry?
Are there any models just do example here?
I mean, you can't predict the future prices, right? So I'm not sure how you would predict kind of your impermanent loss. Right. Exactly. So here, right? You can do that here already. If you know the price goes in one direction, then you can see where on the curve you would end up, right? That's the relative change here of the assets, right? Okay, I'm sorry, we're out of time. Yeah. But we have a coffee break and then we continue with the lecture. Yeah.